Social Security alert for seniors 65 plus. Big changes are being talked about that could directly impact your pension payments and financial security in the US, and most people have no idea what's coming next. If you're retired or planning to retire soon, you need to watch this till the end because it could affect how and when you receive your Social Security benefits. And I'll break down what's really happening, what the government isn't clearly explaining, and how seniors can protect their income right now. And if you want simple, honest updates on Social Security pension changes, payment updates, and the real pension crisis in the US, make sure to subscribe to this channel because this is the only place where we focus only on updates that matter to retirees like you. You know what keeps me up at night? It's the phone calls I get from seniors who just realized they made a financial mistake that could cost them everything they've worked their entire lives to build. And the crazy part is, they made this mistake because they were trying to do something good, something loving for their family. They put their kids' names on their checking account, thinking it would make life easier, thinking it would help when they got older, thinking it was just a simple, harmless thing to do. But let me tell you something that the banks don't want you to know, something that financial advisors are finally starting to talk about openly. This one decision, this one seemingly innocent act of adding your child's name to your checking account could absolutely devastate your financial future. And it's happening to seniors across the country right now as we speak. Let me paint you a picture of what's really going on here. Margaret was 72 years old, a retired school teacher who lived modestly but comfortably on her pension and Social Security. She had about $85,000 in her checking account, money she'd saved carefully over decades. Her daughter Susan was always helpful, always there when Margaret needed something. So when Susan suggested that Margaret add her name to the checking account just to make things easier, just in case Margaret ever needed help paying bills or if something happened, it seemed like the most natural thing in the world. Margaret walked into her bank, filled out the paperwork, and just like that, Susan became a joint account holder. 3 months later, Susan's husband lost his job. 2 months after that, they fell behind on their mortgage. And when the bank came looking for assets to satisfy their debts, guess what they found? That's right, they found Margaret's checking account with Susan's name on it. And legally, that money was now considered Susan's asset too. Margaret lost $40,000 before a lawyer could even begin to untangle the mess, and the legal fees ate up another $15,000. Years of careful saving gone, just like that. Now you might be thinking, well, that's just one extreme case. That would never happen to me. My kids would never let that happen. But here's the thing. It's not always about what your kids would or wouldn't do. It's about what the law allows to happen once you make them a joint owner of your account. And this is where things get really interesting because most people don't understand what joint ownership actually means. When you add your child's name to your checking account, you're not just giving them permission to help you out. You're making them a full legal owner of every single penny in that account. That means their creditors can come after that money. That means if they get divorced, their spouse might have a claim to half of what's in that account. That means if they get sued for any reason, that account can be targeted. That means if they have tax problems, the IRS can put a lien on that account. And here's the kicker. None of this requires your child to do anything wrong or irresponsible. They could be the most trustworthy person on the planet, but life happens, circumstances change, and suddenly your life savings is in jeopardy. But wait, it gets even more complicated. And this is something that almost nobody talks about when they're sitting in that bank having this conversation. Let's talk about Medicaid and long-term care, because this is where things can go from bad to catastrophic for seniors. If you ever need to go into a nursing home and you need Medicaid to help pay for it, and let's be real, nursing homes can cost anywhere from $5,000 to $15,000 a month. Medicaid is going to look back at your financial transactions for the previous 5 years. They call this the look-back period. Now, if you've got your child's name on your checking account and your child has been writing checks from that account, even if they were writing checks to pay your bills like you asked them to, Medicaid could consider those transfers of assets. And if Medicaid decides that you were transferring assets to your child to hide money from them, they can hit you with a penalty period where they won't cover your nursing home costs. I've seen seniors get hit with penalty periods of 6 months, 12 months, even longer, meaning they have to somehow come up with tens of thousands of dollars to pay for their care, money they don't have because it's all gone. Here's another scenario that plays out more often than you'd think, and it's heartbreaking every single time. Robert was 78, a widower with 3 adult children. He put his oldest son James on his checking account because James lived nearby and could help with bills and errands. Robert's other 2 children, David and Sarah, didn't think much of it at the time. Then Robert passed away unexpectedly. Now, here's what Robert thought would happen. He thought the money in his checking account would be split 3 ways among his kids according to his will. But here's what actually happened. Because James was a joint owner on the account, that money legally belonged to James the moment Robert died. It didn't go through probate, it didn't get divided according to the will, it just became James's money. Now, James could have done the right thing and split it with his siblings, but he was going through his own financial troubles, and he convinced himself that his dad must have wanted him to have it since he put his name on the account. David and Sarah were devastated, not just because of the money, but because it tore their family apart. They haven't spoken to James in 4 years. And let's talk about something else that banks definitely don't explain when you're sitting there signing those papers to add your kid to your account. Once your child's name is on that account, they can do whatever they want with that money, and you have absolutely no recourse. They can walk into the bank tomorrow and withdraw every penny, and it's completely legal because they're an owner of the account. Now, I know you're thinking, my child would never do that, and you're probably right. But I've been doing this long enough to tell you that I've heard that exact sentence from dozens of seniors who later called me in tears because it happened to them. Sometimes it's not even malicious. Sometimes your child genuinely believes they're borrowing the money and they'll pay it back. But then life gets in the way and that payback never comes. Sometimes there's a family conflict and emotions run high, and suddenly that money becomes a weapon in an argument. Sometimes your child has their own addiction issues or mental health struggles that you don't fully know about, and they make impulsive decisions they later regret. The financial institutions know all of this, by the way. They absolutely know the risks involved in joint accounts between seniors and their adult children. But you want to know why they still make it so easy? Why they still suggest it as a solution when seniors come in worried about managing their accounts as they age? Because it's simple for them. It requires minimal paperwork. And frankly, what happens to your money after you sign those papers isn't their problem. They've covered themselves legally. You signed the documents, you made the choice. And if things go sideways, that's your family matter to sort out. They're not going to step in and protect you just because you didn't understand the full implications of what you were signing. Now let's talk about taxes, because this is yet another dimension of this problem that catches people completely off guard. When you add your child to your checking account, you might think you're being smart about estate planning, avoiding probate, making things simple for when you pass away. But the IRS sees things differently. Depending on how much money is in that account, adding your child's name could be considered a gift, and if it exceeds the annual gift tax exclusion, which right now is around $18,000, you might have to file a gift tax return. And even if you don't owe gift tax right now because of the lifetime exemption, you're using up part of that exemption, which could create tax consequences down the road. Then there's the issue of what happens to that money when you die. If your child sells assets that pass to them through the joint account, they might face capital gains taxes that wouldn't have existed if the assets had passed through your estate instead, because of something called step-up in basis. Your child could end up paying thousands in unnecessary taxes just because you tried to make things simpler. So what are you supposed to do instead? This is the million-dollar question, right? You're getting older, you want to make sure someone can help you if you need it. You want to make sure your affairs are in order. You don't want to burden your children with a complicated mess if something happens to you. These are all legitimate, loving, responsible concerns. But there are so many better ways to address these concerns than putting your kids on your checking account. The first and most important thing you can do is set up a durable power of attorney for finances. This is a legal document where you designate someone, usually one of your children, to handle your financial affairs if you become unable to do so yourself. The key difference here is that this person is acting as your agent, not as an owner of your accounts. They can pay your bills, they can manage your money, they can do all the things you need them to do, but the money still belongs to you and only you. Their creditors can't touch it. Their divorce doesn't affect it. Their financial problems don't become your financial problems. Another option that's becoming increasingly popular is setting up what's called a living trust. Now, I know that might sound complicated and expensive, but hear me out because it's actually not as bad as you might think. With a living trust, you transfer your assets, including your checking account, into the trust. You serve as the trustee while you're alive and capable, and you name a successor trustee who takes over if you become incapacitated or when you die. This gives you complete control while you're able, provides for seamless management if you become unable, and allows your assets to pass to your beneficiaries without going through probate. Plus, because the assets are in the trust and not jointly owned with your children, they're protected from all those creditor and divorce issues we talked about earlier. Yes, there's usually some upfront cost to set up a trust, maybe $1,000 to $3,000 depending on where you live and how complex your situation is. But compare that to the tens of thousands or even hundreds of thousands of dollars you could lose by having your kids on your account directly. You could also consider something called a convenience account or an agency account, though the availability and specifics of these vary by state and by financial institution. With this type of account, you designate someone who can access the account and conduct transactions on your behalf, but they're not an owner of the account. Again, this protects the funds from the designated person's creditors and legal issues. You need to check with your bank about whether they offer this and what the specific rules are. And ideally, you want to get an attorney involved to make sure it's set up correctly and documented properly. If your main concern is making sure someone can pay your bills if you're in the hospital or temporarily unable to manage things yourself, many banks now offer online banking with the ability to set up automatic bill payments. You can schedule your regular bills to be paid automatically, and you can give a trusted family member view-only access to your accounts so they can monitor things without being able to make withdrawals or transfers. This isn't a complete solution for long-term incapacity, but combined with a power of attorney, it can address a lot of the day-to-day concerns that lead people to put their kids on their accounts in the first place. Here's something else to think about. If you've already added your child to your checking account, it's not too late to fix this, but you need to act now. You can remove your child from the account, though you should definitely have a gentle, honest conversation with them first about why you're doing it. Frame it as protecting both of you, because that's exactly what it is. You're protecting yourself from the risks we've discussed, and you're protecting your child from the temptation, the responsibility, and the potential family conflict that can come with being on a parent's account. Most adult children, when they understand the full picture, are actually relieved not to have this responsibility and risk. The truth is, the whole idea of putting your kids on your checking account comes from an earlier era when we didn't have as many sophisticated financial and legal tools available to us. It was a workaround, a way to try to solve legitimate problems without spending money on attorneys and financial planners. But times have changed, the laws have changed, and what might have been a reasonable solution 30 or 40 years ago is now a ticking time bomb for your financial security. The risks have grown exponentially, while better solutions have become more accessible and affordable than ever before. I want you to understand something really important here. This isn't about not trusting your children. This isn't about being paranoid or pessimistic about family relationships. This is about being smart and realistic about how the legal and financial systems work, and about protecting the assets you've spent your entire life building. You can love your children completely, trust them completely, and still recognize that putting them on your checking account creates risks that have nothing to do with their character or intentions. You're not insulting your children by using proper legal and financial tools instead of joint ownership. In fact, you're showing wisdom and maturity, and you're ultimately protecting your children from difficult situations and family conflicts that could arise. Think about it this way. If you needed heart surgery, you wouldn't ask your neighbor to do it just because you trust them and they're willing to help, right? You'd go to a qualified cardiac surgeon because that's the appropriate professional for the job. The same principle applies here. Managing access to your accounts and planning for potential incapacity isn't something you should handle with a quick trip to the bank to add names to an account. It's something you should handle with proper legal documents prepared by an attorney who understands elder law and estate planning. Yes, it costs a bit more upfront, but it costs so much less than the disasters I've seen unfold when people take shortcuts. Let me share one more story with you, and this one has a happy ending because I want you to see what's possible when you do things right. Eleanor was 74 when she came to see me. She had already put her daughter Linda on her checking account years earlier, and she was starting to have second thoughts because Linda was going through a messy divorce. We removed Linda from the account, set up a durable power of attorney, created a living trust, and established automatic bill payments for Eleanor's regular expenses. 3 years later, Eleanor had a stroke that left her temporarily unable to manage her affairs. Linda stepped in using the power of attorney, handled everything beautifully, and when Eleanor recovered enough to take back over, everything was exactly as it should be. Then, when Eleanor eventually passed away at 82, her assets passed through the trust to her three children equally, exactly as she wanted, with no probate, no delays, no family fights, and complete protection from any of her children's financial issues. That's what proper planning looks like.
The bottom line is this: your checking account represents your financial independence, your security, and quite possibly your ability to care for yourself in your later years. Protecting it isn't selfish, it's essential. You owe it to yourself and actually to your children to handle this correctly. Don't let a bank employee who's just trying to process your request quickly convince you that joint ownership is the simple solution. Don't let family pressure or fear of seeming distrustful push you into a decision that could haunt you for years to come. Take the time, spend the money, and work with qualified professionals to set up proper legal protections that achieve your goals without exposing you to unnecessary risks. Your future self will thank you, your children will ultimately thank you, and you'll sleep better at night knowing that the money you work so hard to save is truly protected and will be there when you need it most.